and welcome to the Flow podcast by Finery Markets. My name is Konstantin Shulga. I'm the CEO and the co-founder of Finery Markets, the leading crypto ECN and electronic trading software as a service provider. And on our series of podcasts, we talk about the evolving market structure in the digital asset space with the industry leaders. And today we have Tim Bevan, the CEO and co-founder of ETC Group, the European largest trading Bitcoin product and the most liquid one. So Tim, we're really glad to see you here.
Yeah, great to be here.
Thank you. So to begin with, you are a market expert with more than 20 years in the traditional capital markets, having the expertise within the electronic trading space. And I guess when you just started your career with the London Stock Exchange, you were involved in the product space with ETCs and ETFs. So looking backwards, it seems quite logical for you to venture into something like starting an ETC group. And can you share a bit more? How did you make this decision? So on your website, you state that crypto is a once-a-generation opportunity. And can you elaborate a bit more on how you make this choice and how you make this leap of faith from the traditional space into the digital assets?
Yeah, sure. I mean, I think really what brought me in was more structuring than necessarily a deep-rooted belief in Bitcoin or crypto at the time. I've always loved market structure, and it's always interesting to me to find new, elegant, efficient ways for markets to trade. And along with the co-founders, we were looking at the European market. There were one or two products out there, but we felt there was a structurally much better way to do it. And this, as you said, keyed back into my experience way back when at the LSE, when exchange-traded commodities came about. So gold was an interesting problem. It's a non-UCITS eligible asset, and obviously doesn't meet any diversification criteria, so UCITS funds were out. And I remember when Graham Tuckwell and ETFs came to market, they came to London trying to launch a gold product. And it was a nightmare. They couldn't do a UCITS fund. They had to look at various structuring opportunities or ideas. And eventually they ended up with a structure that was a bond that trades like an equity, that gives exposure to a commodity, that everyone assumes is a fund, and was originally regulated like a derivative. So it was kind of a weird thing that came to market, but it did the job. And they went on an incredible journey in terms of asset gathering and AUM growth. And the gold products in Europe now up to 100 billion across various products by all the major providers. So this is an old structure. This structure is 13 years old. And it occurred to us that, well, Bitcoin shares a lot of the same features. And again, you can look at Bitcoin and crypto through different lenses, depending on the problem you're trying to solve. But certainly looking at it through the commodity lens presented a very elegant and easy solution. I say easy, but already existing solution when it came to structuring. So you take gold out of a vault and you put Bitcoin on a cold server, and that exchange-traded commodity structure works for this asset. So we were big believers in this. We saw the benefits of it. It's open-ended. You've got create, redeem. You've got much better price tracking. And again, in the structuring, you can put in good protections to bondholders. So we felt it was the best way to own the asset. It was the best way to provide liquidity and an on-exchange or tradfi instrument to access Bitcoin. It was a tricky journey. We spent a lot of time in various places in Europe trying to find effectively a regulator that would engage and sort of listen to the arguments and potentially approve a prospectus. I mean, we spent a bit of time in Sweden, but were sort of politely told the door was shut. We did look at Switzerland, but we really wanted to be EU. And, for us, I think game changer was finding a really great advisor in Germany who really backed us and gave us a lot of support. And then we spent a year with BaFin. I think 15 turns on the prospectus was a new personal best for the lawyers involved.
Which is a decent result for something that new.
Yeah, but it took time, and quite rightly so. Right? It's a new asset class. It's got a unique set of risks, and regulators are always going to be cautious. But it was a constructive dialogue from the start. And even quite early on in the process, we could feel that we were going to get there. Just a lot of sweat capital and legal fees to get there, but we knew we were on the right track, and that was really the start of the business. You know, being the first through the gate with BaFin, getting a product onto Deutsche Börse, the biggest ETF board in Europe, being the first time it was properly cleared, so secondary market way more efficient and safer. And you know, we felt that genuinely brought something new to the market, and it was a good product, and you know, the rest is history. That's why it grew to be the largest and most liquid Bitcoin product in Europe.
It's a great and exciting journey, and so you define the form and the format that best suits what you believe the space at that time. But taking just a step back, why digital assets? Like, when and why did you make that decision of like you're going to do that space? And actually, like, you started 2020, it was already like almost beginning this proper massive bull cycle. But did you involve into crypto before that? Or?
Well, if I'm honest, not heavily, no. I mean, you know me, I'm a broker by trade, right? So
and just a disclaimer, I guess we know each other for like 12 years or something.
Yeah, exactly. So I'm a broker, and I look at an asset, and if it's liquid and it trades, it's interesting, right? By definition. And I came at this looking at Bitcoin, and I looked at it a bit more closely, but not really in terms of what Bitcoin was, but just how it traded and the level of activity and the level of liquidity. It looked like a huge opportunity to me at that time. Now, obviously, since coming into the space and spending full-time commitment to crypto and digital assets, I have drunk the Kool-Aid. Right, I'm now a huge believer. And how often in a financial services career do you get to experience a new asset class? I mean, this is a rare and wonderful thing, and you're solving new problems on a first principles basis. You're doing new things the whole time. It's been a fascinating journey, and watching the market evolve and watching people's attitude towards this market evolve. And nothing polarizes opinion as much as crypto, it seems. And at times it's almost hysterical, very emotional discussion. But it's been absolutely fascinating. And the more time you spend in it, the more once you see it, you can't unsee it. And the transformative power of this technology is right up there with all the major tech epochs that we've seen over the years. And we've seen a few. I mean, people always talk about the internet, but I remember when high frequency trading turned up in capital markets. I mean, that was a big event, and a lot of people were very suspicious and very anti at the time. But technology is inexorable. You can't fight it. You have to adopt it, manage it, work out where the risks are, and then exchanges, regulators get to a new paradigm, and that efficiency, that big step forward feeds through to a much better market structure. And I feel it's the same with DLT, that it's new, it's a bit scary, it threatens certain incumbents, it's not well enough tested, it's not well enough developed, but
But you were brave enough to challenge that.
Yeah, but the potential within it is inarguable. And it's amazing to me now, it was quite common back in the day, everyone screaming Ponzi scheme, retail casino. And now we have Larry Fink, who's one of the biggest cheerleaders of the technology and the asset class. So, being part of that journey has been fascinating.
Sounds great. And I think it's only the beginning. And
yeah, we are still very early stage. We talk about institutional adoption, but it hasn't happened yet. It really hasn't happened. So we're at the start of the journey.
Just the tip of the toe, I guess, that's entering with all of this happening right now.
Yeah, look, it's definitely happening, but institutional adoption is slow. It's measured. There's a lot of detailed, heavy work that needs to be done, and you can get distracted by price movements and the woo-wah of the kind of crypto market. But real institutional adoption is a slow, incremental process. and it doesn't happen overnight.
Yep.
You know, you don't wake up on Tuesday and institutions have turned up, right? It is an inexorable tide, and that's what we're witnessing right now. And you know, I find it very hard to argue with the outcomes when you look at some of the supply-demand imbalances. The only adjustment factor is price. So you know, these conversations are getting better. I think the way the industry presents itself is more professional. I think there's more finance professionals coming into the crypto space. You know, better thought through investment cases, valuation models, translating this asset class into a language that professional money managers understand and frankly need in order to treat it seriously. So the whole thing's evolving rapidly, and you know, I just see exponential growth.
So tell us a bit more about the history of ETC and like the key milestones that you went through. So you started in 2020. You've caught some of this excitement bull market, and then the crypto winter, which you survived. But did you feel in any moment in time of like giving up throughout the winter? And how did you went through that? So can you share some of the key insights and milestones?
Well, there's that old phrase in financial markets, isn't it? It's better to be lucky than be good. Ideally, you're both.
Yeah.
And you know, it's hard to deny that we got our Bitcoin product lit on Deutsche Börse in June 2020, which was pretty much perfect in terms of timing. We had enough time to bed it in. We had enough time to make people aware of it. And then, of course, we started getting the crazy price actions from November that year onwards. So it was an extraordinarily successful product launch. I mean, I think we went through 1.5 billion AUM with 3 employees. And, you know, no one was expecting it to perform like this. So, now in 21, there was a lot of catch up for us in terms of building out the corporate infrastructure to support the market. And I guess actually because we were quite new, we were quite young, we didn't have a crazy expansion in 2021, which a lot of crypto firms or crypto related firms did. So, you know, when the bad times hit November 21, you know, through 22, we were already quite lean. We didn't have this massive downsizing challenge or huge cost base issue that a lot of firms had that had really expanded rapidly throughout that bull market in 21. That's not to say I enjoyed 22 particularly, but it was much easier for us to manage as an organization, given the size and shape we were going into that downtick. But even then, you know, it was so clear how cyclical this market is. And again, you know, we've been around markets a long time. You kind of knew almost you could work out when things were going to get better. And okay, cycles are cycles, and no cycle's the same as the past one. But we had such a high degree of confidence that the next cycle was probably going to be the one where this market truly became institutional, and we never lost that faith. It's difficult to keep people motivated. It's difficult to keep everyone focused on that long-term objective. But I think certainly amongst the senior management, we didn't have a shadow of doubt as to what was going to happen and what is playing out at the moment.
Like you made it to that point, which, as we mentioned, it's only, I guess, the beginning. So congrats on the journey.
Yeah, thanks.
So now let's dive a little bit deeper into the weeds of the market structure. And if we talk about the exchange-traded products, they've been there for quite a while already. Like just in Europe alone, I guess there are 73 ETPs, and you're definitely the expert, you might correct me here. But like last year alone, it was around 7 billion AUM for those products. And you guys represent like a big portion of that. And the ETFs been approved this year. I guess you're might be pretty tired and sick of being asked what's your view and like what do you think is the impact of the ETFs on the industry, which I guess should not be underestimated. And why do you think with all of the ETPs that's been there for quite some time, it's only actually this year when ETFs being finally approved, it became like a hot topic And everyone is talking about that still a few months after the ETF's approval.
Well, look, it's difficult to overstate just how big US capital markets are, right? In terms of depth of liquidity and activity, it puts the rest of the world in the shade. And for that market, the world's biggest market by a country mile, to effectively adopt and legitimize these products is a big event. It's a huge event. And this is why we're seeing all-time highs ahead of the halving, uniquely in this cycle, because that US ETF event is such a meaningful event. So yes, I have to say that unfortunately Europe plays second fiddle in terms of the sheer depth and power of capital markets. So yeah, it is a very important event. And I think, again, not just for the US and the sheer size and depth of that market, but inevitably, global regulators, global central markets providers, infrastructure providers, global governments, they all look to the US. And it's been a huge legitimization. It's very different me saying, oh, Bitcoin's an investable asset. Frankly, Larry Fink carries a bit more weight. So it has been a huge event. I mean, and it shouldn't be overstated. I think the whole launch was a bit hysterical. SEC website hacks and last-minute adjustments and price wars. I mean, the whole thing was a bit of a circus. But that does not diminish from the size of an event it is for the industry, which is huge. And you can see it in the price action. Bitcoin's a big global market, and this has had a massive impact on it.
And I know it's almost impossible to make such bets, but let's try. How do you think we'll see this, like the share of ETFs on average? What do you think is the fair proportion, or like the fair value within just an average ETF or for a crypto?
So we did a sort of back of the fag packet model to try and work out, okay, how much asset potentially could US ETFs gather. I won't go through the methodology, but we kind of came up with a number of about 40 billion, and we're at 11, 12, 2 months in, and this is before the wirehouses have approved it, the Morgan Stanleys, the Bank of Americas. This is before the big advisory networks have approved it. Wow. This is before the real engine, the real distribution engine of the US has even kicked in, because it takes 3 to 6 months for them to do the due diligence, to decide which products they're going to approve on their platform. Just
educating the sales forces, I guess, is also...
Exactly, right? So this hasn't started yet, really. And it's got a long way to go. And I suspect our 40 billion will be quite a sharp underestimation of how much comes in. So, this story's got a long way to run. This is just the start of the US ETF story, because, as I say, those big distribution machines simply aren't there yet.
Indeed. So, like, it's a nice thing to have such a bet, whereas 40 billion is only like a smaller portion looking backwards of what might actually happen within the next 6 to 12 months.
Yeah, I mean, that alone is a 30% uptick in terms of global AUM of Bitcoin and investment products. Now, we talk about Bitcoin as this, wonderfully liquid, huge, but it's a small asset, right? I mean, we're talking, under $1 trillion?
Well, right now I think it's a bit over, like 1.3.
1.3 trillion market cap asset. This is small in the context of other asset classes. So, these effects are material, very material. And I think it's got a lot further to run. So, again, I mean, it's just so hard when you look at the demand picture, and this is a demand shock event, and there will be ripples to other markets. And then you look at the supply side story with the halving coming up. It's not a complicated model, right? Supply, demand. And the only thing that can adjust is price.
And, well, if we're talking about price, let's talk about the liquidity and the market fragmentation, which I think we both can agree that crypto is the most fragmented asset class in the human history and in the history of capital markets, with a few hundred exchanges, with probably hundreds of thousands OTC providers and different venues that exist in the space. And with exchange-traded products, we see the next level of fragmentation where liquidity expands beyond just like the crypto infrastructure into the TradFi. And yourself, you pioneered with the listing on Citra. Right now, your product is traded on, I guess, 10 different European exchanges.
Venues, yeah, I would say, yeah.
And this by itself already creates like a next level of fragmentation. And we as an ECN in the space, we also try to solve the issue of liquidity fragmentation by consolidating certain players and liquidity providers. So how do you see this market will impact the ETF, ETC, ETN space? And do you guys see, and like maybe you see any feedback from your APs, the impact of that fragmentation on the liquidity and the price discovery, or how do you can comment like this issue, if there is an issue for you guys and like for the industry in general?
Yeah, well, I mean, again, it's kind of unique in capital markets history that this market grew organically out of an unregulated retail-driven space. So yeah, extraordinarily fragmented liquidity in the crypto native space. I think now we are moving to a much more regulated mindset and environment, and sort of ETFs and products on traditional exchanges are an expression of that. They simply wouldn't be allowed if it wasn't felt that the underlying market had some integrity, and you see that from all the unfolding story with the SEC over the past couple of years. So I actually think that the movement of some liquidity on traditional exchanges will actually force quite a lot of liquidity consolidation in the underlying market, because regulation's here and it matters. And we look at the US ETFs with the cash, create, redeem being mandated on them, and this is effectively putting a huge amount of pressure on the NAV benchmark, and I don't think it's the most efficient way to organize that market. But it's forcing liquidity through a small number of regulated or acceptable, in inverted commas, exchanges. So I think the increasing regulation and adoption by the broader regulated financial market of Bitcoin and crypto will force quite a lot of consolidation in terms of liquidity in the underlying market. Whether putting it onto traditional exchange infrastructure is creating further fragmentation, I guess so to a degree, but that's just a feature of how the market structure's developed in Europe over the past 10 years since MiFID and the breaking of the homogeny of the national exchanges. And that debate rolls on in Europe year in, year out. Competition good, fragmentation bad. What's the right model? Does it matter if execution liquidity is fragmented, if clearing and settlement is efficient? And that rolls on and on. But I think really the overall impact of the movement towards traditional financial markets and traditional venues is going to force a lot of liquidity consolidation beneath.
So you believe like that we will not see like those hundreds and thousands of venues, and you believe in the consolidation of the market?
I think so, yes. Because as venues are forced to adopt regulation and all that goes with it, that's costly, right? And economic viability and consolidation becomes a key driver. To run regulated exchanges is no small undertaking, and the responsibilities and scrutiny that come with it. So, you can't just do a bit of tech and set up a two-way engine and hope for the best. I think that forces a lot of consolidation. And I do think we'll see crypto move towards a more traditional markets
like
infrastructure
FX,
model.
what do you think is the most appropriate way, like asset class, to compare it? Like Is it more of an FX, or like 70% FX, 20% equity?
Well, I mean, look, in practical terms, it's FX. It's 24/7 with no home market.
Yep.
And in that sense, no natural liquidity points in terms of auctions or anything else. So from a trading perspective, it looks FXy.
Yep.
From a risk perspective, it looks equity-y. And from a structuring perspective, it's quite useful to see it as commodities. So again, it depends on the lens. But yeah, I think FX is the best trading analogy. It has to be, given the nature of the liquidity in that market. But yeah, the idea that sort of crypto upends everything, which was kind of the thinking back in 21, it revolutionizes everything, the way we think about risk reward, the way we think about market structure. It's just patently not true. Modern market structure has evolved over 200 years. And it's structured the way it's structured for good reason. Why do we separate execution, custody, clearing? It's becoming pretty self-evident in terms of the growing pains that crypto's had.
Especially after the FTX.
Exactly.
Yeah.
So, there is good reason why traditional markets are structured the way they are. And I think we'll see increasing alignment of crypto towards that model.
Yeah, I couldn't agree more. And so now we kind of touched upon the market space and the framework. Let's talk a bit more about the products itself. So I am subscribed to your ETC one-on-one and the research, and I'm a big fan of that. And you guys have a really good report called Why Structure Really Matters, where you describe the differences between the ETFs, ETPs, and ETNs. And I encourage everyone to actually go and read that report. But for those listeners that don't have enough time to do that, can you sum it up, like just in a few words? What are the main differences between the ETPs, ETFs, and ETNs?
Yeah, it's been a source of huge confusion in the market, and it doesn't help having 5 or 6 different acronyms all starting with ET out there. So as I said earlier, the the standard route of an ETF in Europe is a UCITS fund, and that's just not possible with this asset class. And again, we adopted an exchange-traded commodity structure. And I remember speaking to Deutsche Börse saying, well, now you've approved it, could you list it with the ETCs? Because that correctly reflects the structure, the 100% asset-backed nature of it. And they said, well, no, it's not a commodity, so we're going to stick it with FX products with ETNs. And I said, well, that's going to be confusing because ETNs aren't usually backed by asset. They are effectively promissory notes from the issuer, and you face their credit risk until such time you get the payout. So it created a lot of confusion. So ETPs is the umbrella term for anything that is exchange traded. Then you've got ETFs, which in UCITS would imply usually a UCITS fund. Not all ETFs are UCITS funds. There are some other structures out there, but the vast majority, what people assume an ETF is in Europe, is a UCITS fund. Then you have exchange-traded commodities, which had this feature of being physically backed, like the gold products. So for every bond in issue, there is gold in a vault backing it, and similarly with the crypto products. But it is a debt structure, so you can correctly call that an ETN. But ETNs would normally be associated with sort of bank-written products, index-related, and we will pay you this return at the expiry of the product or on a daily basis, and you face the issuer as a credit in terms of fulfilling that commitment. So it's quite nuanced, and then you have to, once you've established, okay, what is this thing, then you do have to look carefully at each issuer, because the quality of the structuring and the base prospectus, the final terms, the terms and conditions of the product, there is variance. Now, what can I do with the underlying asset? Can I lend it? Can I rehypothecate it? And there is variance between individual issuers as to how secure those underlying assets are, how well it's structured in terms of bondholder protections. Having a trustee is important, having a third-party administrator is important. And you've got to look carefully at the features to understand how safe or the quality of competing products. And that's why we produce that note, because it's important to do your own research in this space as much as it is in the crypto space. You know, really understand the instrument you're holding and the risks you're facing.
And it's great you're sharing the market knowledge. So let's get back to this liquidity question and the concept, which I would like to address the question on the competition. We do see that there are a lot of traditional institutions entering the space, and they're starting to explore the ability to settle and clear the spot product on the exchange side. So do you see just the traditional crypto infrastructure as your competition? And how do you see that competition will evolve? So what are the main value adds that your product adds and brings into the table? And how do you see that potential competition evolving in the near future?
Yeah, I mean, it's a good point. So, you know, with a gold product, there's obviously very practical issues in warehousing gold. You know, theoretically, with the digital assets, there's no headache in warehousing digital assets.
Almost. No.
Almost. But I think, you know, ETPs will play a big part for quite some number of years. The network effect of being able to hold and custody professionally digital assets is going to take years. I think ultimately all central markets infrastructure will move on to DLT and sort of tokenization. But again, that's 5 years plus, right? It's going to take a long time for the technology to really be adopted throughout the whole ecosystem. And it's going to take a huge amount of time for, you know, institutions and professional money managers to build out digital asset infrastructure in order to be able to hold and warehouse and custody and asset service these products. Because necessarily and quite correctly, they're very risk adverse. And the market is evolving quite fast, but you know, this technology has to be battle hardened and tested for many years before a lot of institutions will touch it. And that's happening. But I think it's always dangerous in this business, especially in a tech-related sector like this. It's fun to be a futurist, and it's almost easier to be a futurist. We all agree this is where it's going to end up. The trick is working the path and how long it's going to take to get there.
And all the legacy infrastructure. And we've been there in the markets. Like, we know how the banks and the brokers work. And like, we know all this, like hundreds of vendors that need to adjust, you know, to
it takes a lot of time. And if you're not careful in business, you run out of money before your futurist vision comes true. And I think the key thing is to match the speed of the market you're servicing. And we found that in the ETP space. There's almost limitless things we could issue on because of the nature of the asset class, and you know, very elegant risk return profiles and multi-factor index products, and you know, harvesting a lot more on-chain data to create, you know, really smart ideas. But who's the buyer? And at this stage of the market, where we're still fundamentally explaining the difference between Bitcoin and Ethereum, and people are beginning to feel their way in, you know, you have to be conscious of that's where the market's at, and this is the speed at which the market's moving. And your desire for it to move faster is kind of irrelevant. You know, you have to trade what's in front of you. So, you know, we put a lot of value on limited product range, but very transparent, very high quality, and consistently pushing out those core messages. And we will issue new products. We will look at more complex or interesting products as we feel the demand profile evolving over time. But that does take time.
And talking about new products, so we all saw that in past, that after the bull cycle with like the Bitcoin and Ethereum prices going up, then a lot of the focus shifts into the smaller coins and some altcoins. So can you share a bit more? Do you see the demand from your clients into supporting more smaller coins, like outside of top 5 or like even top 10? And what are your plans in supporting those products?
Yeah, I think you do have to segment the market into Bitcoin and everything else, because Bitcoin's a standalone asset, and the whole investment case, valuation model behind it, its whole use case, how you understand Bitcoin is very separate to everything else.
Sometimes it's more of a theological question, I guess.
Well, I mean, it's the hardest one, really. It's the most philosophical case. I mean, Ethereum is a lot easier. It's a tech company, right? It's got cash flows. You can DCF it. This is something that's much more familiar to guys operating in the equity space.
And just the recent news, I guess, we'll just see once again whether it will be treated as a security with the recent news from the SEC. So we'll see.
Well, yeah, you know, it is a tech company. It's an operating layer through gas fees and staking rewards. It has cash flows. You know, it should be understood in my mind as a technology company. It's the clearest and cleanest way to understand it and build the investment case around it.
This is a proper Web3 security, basically.
Yeah, that's it. It's a monetizable TCP layer. So yeah, I mean, in some senses, the conversation around an asset like Ethereum is easier because you're speaking the same language, and the investment case is perhaps clearer. So we do see a lot of interest in Ethereum, and obviously, the challenge for guys in my space is how to incorporate the staking returns, because it's such a fundamental part of the economic profile of the asset. To not be able to incorporate that into an investment product is a big miss, right?
And you launched quite a unique product on that with your like ETH staking.
Yeah, so it's the only one that's actually benchmarked to a staking index return. And again, it's that ethos of transparency, and really allowing the product holder to see on a transparent basis the return they're getting versus, you know, very good, pure, well calculated independent benchmarks. So there's been big focus on that. We have a lot of discussions about Ethereum. I think then as you kind of move down the list, then you're just hitting problems of people just don't know enough. I think maybe Solana is a bit of the belle de jour in terms of a layer one alternatives to Ethereum. Chainlink has got some institutional interest again because of the unique problems that's trying to solve. But really outside the big two, it becomes challenging. And then I think you really should be looking at more index-based products. You know, the analogy I like to use, it's like VHS versus Betamax, except there's 1,000 of them. And with the best one in the world, you don't know, right? Yeah. You can have views, you can even have quite high conviction views, but you don't know. And I think as we move down the list, then index products and diversifying that risk makes a lot more sense. Now at this stage, I mean, we only really see demand for kind of a broad market benchmark index, but really more thematic or sectoral index products, I think, will be the next wave. Rather than trying to pick winners at the individual protocol level, dangerous.
Yep.
But you know, buying a basket of sort of 10 DeFi-focused protocols is a more sensible way to invest, I think, for most traditional asset managers, who, let's face it, they have a day job, right? Their total allocation to crypto is going to be 1 to 5%. So they're not going to spend a big chunk of their time analyzing the relative merits of one layer one versus another. That's going to be a very specialized asset manager role in a fairly niche part of the market. So you've got to design products that allow people flexibility to a point, but you're not asking them to go too far down the rabbit hole.
So talking like index, I think makes total sense for the industry to evolve there. Once again, if we're launching like a product, something like index, it probably should be listed in the traditional space because it is clearly a security. And do you feel that the index products, there's some room for them to be listed on chain? And can you recommend like any projects or products to track in the space?
Yeah, no, we've looked at this obviously because there's, you know, again from a markets perspective, there's this very elegant idea of having two pools of liquidity, and one in the tradfi space, one in the crypto native space for a token, and allowing market makers to operate in two pools of liquidity. You know, it's got it's a very attractive concept. But in reality, we're just not seeing the liquidity profile. There's a number of guys in the space, and I think it will get there in the end. But you just don't see the demand from within the crypto trading sort of liquidity pool and participants for this type of product at this stage. Surprises me slightly. I would have thought it would make sense, but it still seems to be a very kind of high conviction market. People choose their protocol and off they go. The attractiveness of more investment products doesn't seem to be taking hold to me yet at this stage. I think it will. It's a timing issue, but I don't think it's there yet.
We'll see. We'll see. So what are the main milestones for the ETC group there going forward? Like, what are your goals for the next year or two? What industry innovations will you bring to the space?
As I say, we're trying to be quite thoughtful about issuance. We don't believe in just spraying the market with 50 different products. We're going to try and bring a smaller number of well thought through, well structured products to market. And it has to be demand driven. I mean, again, this idea of really matching the speed of development of the market you're servicing. And we are servicing traditional asset managers, private banks, wealth managers. So, we have to think carefully about where they are on their journey and what realistically they have appetite for. Indices, I think, will inevitably play a much bigger role. I mean, how much value does an ETP give in just wrapping up Bitcoin? It's not doing a great deal of work there, right? That's a very commoditized product. An index is actually doing something. It's diversifying risk. It's through quarterly rebounds. It's capturing stuff that's coming up the list and getting interesting. So I think indices is a very natural evolution, and I think will become the mainstay outside of Bitcoin. It just makes too much sense for it to be anything else. But I think for us, it's really about distribution, right? It's converting these long-standing conversations into investment. It's broadening that investor base, that church of investment base across Europe. And Europe is, it's dislocated at the best of times, but when it comes to crypto, the regional variance is huge. Tone comes from the top, it comes from regulators, and where you've had relatively neutral regulators, as you have had in Switzerland and Germany, that's filtered down. So you're able to have much more reasonable conversations with institutional guys in those markets at this stage. Take a market like the UK, where it has historically been very hawkish. It's still really tough to even start a conversation. And we see that variance in other markets as well. Italy is now becoming a major market for crypto products. France feels quite a long way away. So this variance is there. You have to focus on where the demand is at a certain point in time. You have to build reputation, build trust, build relationships. And then hopefully as other markets will catch up or begin to be more open to this type of product. So really building that distribution network, that trust, that visibility across the European landscape is probably our number one objective.
So looking forward to that. Any plans to expand to US or like to touch the capital market pie of the US?
US is a tough market, and I think it's going to be fairly heavily broked. The market will develop at the speed the regulator allows it to, but as and when the regulator does allow it to do new things, there will be a lot of people competing for that ticket. And I don't fancy being in that race personally. We do see expansion opportunity outside of Europe. We do have a couple of conversations going on in different jurisdictions, looking south, looking east. So yeah, we're always looking for new markets and new opportunities. It does mean partnership, right? Because if you're going to a new market, you can't expect to turn up on the local exchange, get a two-way price up and people run in and buy your product. It simply doesn't work like that. So, you have to be reasonably humble about, okay, what am I bringing to the party? How can I find a local partner to work with? Is this coincidence of wants? Is this a good trade for both of us here, and can we make something happen? So we're always looking to find those conversations.
And well, we can only wish you luck with the expansion and like all the plans. So wrapping up the conversation, what do you think are the major milestones, and what is needed for a quantitative leap for the entire space and for the whole crypto adoption across the institutional clients to make it not a 1.3 trillion product, but to make it like a $10 trillion product?
Okay, well, again, putting Bitcoin to one side, everything else needs to find use cases and adoption, right? That the VC money tap of 21 will probably never be repeated, and a lot of these projects now need to find commercial success. There needs to be real adoption. There needs to be real.
Can you name a few? Like, it'd be great to hear your opinion on what are the actual use cases that you think should drive the market.
Well, again, I mean, the Web3 is still quite conceptual. We need to see a lot more utilization, commercially and otherwise. We need to see these kind of projects that the corporates are running really as thought experiments or whatever translate into actual commercial activity. We need to see the technology deliver changes in behavior and actual commercial transactional flows that produce positive tokenomics, that produce economic value. It's still quite theoretical. It's still quite thought experimenty. And really, that's going to be key for the broader crypto market to kick on. That direct applicability to the real world needs to evidence itself. And it needs to evidence itself, I think, pretty much in this cycle to really continue the path. Bitcoin's a separate story. I think we're already past the point of no return there. I think its future is as a digital gold. The obvious challenge to that concept of it being a store of value is a store of value can't bounce around 15% a day, and that's correct. But I think that's the long-term future state of Bitcoin. We're just simply not there yet. And it can only perform that function when it has a notional value size much larger than it is today. So when Bitcoin's worth $500,000 to $1 million, then the volatility can collapse, and then it can behave as I think the collateral asset it's designed to be. Well, not designed to be, but will end up being. And that is where Bitcoin ends up. But I think we've got quite a lot of price appreciation to come before it can fulfill that function, because it needs to have an overall notional value much higher than it is today. And as we know, supply is fixed. So the only adjustment factor is price.
Well, so summing it up, I guess the future is bright for Bitcoin. Everything else will need to fight for that bright future. So,
well, there'll be definite winners within that group. From a network effect perspective, Ethereum potentially has already won. But yeah, they need to fight for relevance, and relevance is adoption and real world value.
Well, so then let's just do diversify, I guess, and that should hopefully bring us to this bright new future together with the Bitcoin.
Yeah, well, that's it. If you own the index and something goes 200x, doesn't matter if the rest go to zero.
Exactly. So we're looking forward to having more products from ETC Group. And Tim, once again, thank you for being on a podcast. Hope you guys enjoyed it. And yeah, please stay tuned with our YouTube, Spotify, and like the other platforms where you can find the Flow podcast. Thank you.